Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, March 7th, 2025. It's jobs report Friday. So guess what? You know what that means? It's macro scouting report Friday. It'll be a big day for clients at 42 macro. But before we get into that, let's just get into the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 macro. So today's key macro question is, how much will the Trump administration kitchen sink Biden's artificially inflated economy and stock market? Our answers are likely more than what is priced in currently. In an interview on CNBC Squawk Box program yesterday, Treasury Secretary Scott Bessent provided the clearest indication to date that the Trump administration may have the fortitude to sacrifice short-term economic and financial market pain for long-term gain. Again, this outcome is not factored into earnings expectations, nor was it accounted for as global investors flowed trillions of dollars of capital into U.S. assets to position for the American exceptionalism narrative. The February jobs report may be the penultimate jobs report that signals an exceptional American economy. All told, transitioning from paradigm A, which is a buoyant but K-shaped economy propped up by excessive government spending, to paradigm B, which is a buoyant E-shaped economy that shifts the burden of generating economic output back to the private sector, likely requires an adjustment period. Moreover, the trillions of dollars of legacy positioning across asset markets associated with paradigm A to paradigm B, transitioning those trillions of dollars from paradigm A to paradigm B, likely requires a significant adjustment as well. How much of that adjustment has been completed thus far remains to be seen. While we don't know the answer to that question, we do know that our KISS and Dr. Mo signals provide 42 macro clients their best chance of navigating this historic policy uncertainty as successfully as possible. Some investors making bold bets today regarding the path and outcome may be proven right, but those watching them will be remiss to conflate luck with actual skill. No amount of skill can perfectly trade a distribution of probable economic outcomes this historically wide. The fourth turning is rapidly accelerating right before our very eyes. Respectfully, you may not know what you do not know if you think you can perfectly navigate the pending series of global macro catalysts using fundamental research alone. We invite any investor that is overconfident about how this will all play out to review our March 25 macro scouting report presentation this afternoon. That deep dive will fill in the blanks and add a healthy dose of humility to any investment process. Transitioning to our 42 macro dashboard is here. As always, we'll wrap up with a question from our community. This was not quite a question, it's more of a comment. It says, hi, Darius, I wanted to circle back around to this since it is in recent memory. Utilizing the Dr. Mo and KISS adjacent positioning strategy, the majority of my long accounts were down only 40 to 50 basis points yesterday, while the market was down far more. And as obviously as we all know, the KISS portfolio was a blip on the loss radar, one day at a time, but that is definitely a comfort during such a bloodbath of the day. And so thank you for the kind feedback. I felt that in my portfolio as well. As you guys all know, I use our KISS portfolio construction process to manage my entire liquid net worth. That'll be my only position until I die. Until I retire, then down my account or die in retirement. So just be aware of that. One final thing I'll end on here. The entire purpose of our KISS portfolio construction process, and Colin, throw the slide on the screen. The entire purpose of our KISS portfolio construction process is to simplify investing in a way that allows investors to maximize upside capture during bull markets and minimize downside capture during bear markets. KISS is not designed to, predict growth, liquidity, inflation, Fed policy, U.S. fiscal policy, European fiscal policy, the geopolitical risk. It's a systematic risk management overlay, an institutional grade risk management overlay that does exactly what it's supposed to do, which is maximize upside capture in bull markets and minimize downside capture in bear markets. If you compare, so this right here in the screen, you're showing our KISS portfolio construction back test. It's a rolling out of sample back test, is to prevent look ahead bias. And so if you're going to compare KISS, which is a 60-30-10 trend following strategy featuring 60% stocks when it's maxed out, 30% gold when it's maxed out, and 10% Bitcoin when it's maxed out, and those max positions go up and down based on the risk management signals. When you're comparing KISS to, let's say, 60-40, which is, a lion's share of a lot of, retirement type money, KISS has an upside capture ratio relative to 60-40 of 237% over the lifetime of this rolling out of sample back test, which begins in January of 2018. that compares to a downside capture ratio relative to 60-40 of only 48%. So you're essentially, tripling the 60-40 return while only, taking less than half of the drawdown when 60-40 draws down. If you wanted to compare KISS to a sort of naked long, fully invested at all times, 60-30-10 portfolio of stocks, gold, and Bitcoin, KISS would have a 91% upside capture ratio to that portfolio with only a 44% downside capture ratio. So more than a 2-to-1 upside capture ratio to downside capture ratio in the exact same assets with the exact same weights, max weights. So this is awesome stuff. I don't want to toot my own horn, but our clients have been following KISS since January of 2023, and as you just go to our testimonials page and see the returns and the performance and their ability to block out the noise and sleep comfortably at night while maximizing returns in the raging bull market that KISS kept him on the right side of over the past couple of years. And ultimately, as we learn with this comment today, KISS is doing his job to minimize downside capture and what could potentially be a raging bull market or a raging bear market. Again, I'm not making that forecast call here, so don't run away with that. But it could very well transition to the raging bear market, and we'll talk about all the reasons why in our macro scouting report presentation this afternoon. So everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.